Before we get into today's video, some regulatory compliance. My name is Andrew Alexander. I am Head of Investments for Three Counties, an independent financial advisor based in County Durham, England. This video is for anyone who has an interest in investing and investment markets, both retail clients with no experience of investing through to industry professionals who invest for themselves and their clients. As independent financial advisors and wealth managers, there is no commercial relationship between ourselves and today's guest. The purpose of this video is educational, and in no way should any of the content be construed as advice, nor is it an enticement to invest. Past performance is not a guide to future performance, nor a reliable indicator of future results or performance. The value of investments may go down as well as up and is not guaranteed. Therefore, investors may not get back the amount originally invested. And now, onto the video. Welcome everyone to another of our weekly investment manager videos, and many thanks once again for tuning in. After years of struggling performance, UK income investors are noticing some very attractive returns, certainly relative to other markets. However, is this just a flash in the pan, or could we be looking at a return to form for that most traditional of fund sectors? To answer this question and many more, I have the absolute pleasure in talking to Gary Reynolds, Chief Investment Officer and Manager of the Courtiers UK Equity Income Fund. But first, before we get into the content, as ever, it would be marvellous if you could subscribe if you haven't already. It really does assist us in building up the support for our content, our regular financial planning and investment manager content that we try to deliver every single week. So, onto the video itself. Gary, many thanks for joining me today. 2022 has started off, as I said, as a potential renaissance year for UK equities. Why is that?
I think the relative value of the UK equities just got extremely attractive through the last year. You know, if you think about it, the big funds that have had the great runs over the last 10 years, your likes of Terry Smith's fund and these ones, they're very growth focused, and they've got a huge commitment towards the bigger stocks in the S&P 500 index, which is a very tech dominated index. And so if you've had money in there, you can almost sit back and go for the ride, and it's been terrific. But then the spreads got extremely wide. So you were paying, as these stocks went up in price, more and more as a multiple of earnings for your exposure than you would in the less popular FTSE, which has not got the tech dominance, has got more things like banks, materials, pharma, which have been a lot less popular. And as the other one sector's boomed and the money's chased it up, the other sector's been less attractive, which means you could buy the FTSE on 14, 15 times earnings, where you were paying well into 20 times earnings for the S&P 500. And I think what happened, Andrew, the market eventually woke up and said, you know, how much are we prepared to pay for the big five in the US? 35 times earnings? Are you prepared to pay 40, 45, 50? There's come to tipping point when it's just not going to wash anymore, because the more you pay as a multiple of earnings, the higher the rate of growth has got to be for that stock going forward to justify it. But you come back to the UK and you find these lovely stocks when interest rates are rock bottom, you can buy them at 12, 14, 15 times earnings. Some real little gems there. And the market began to react to them as we come into this year. I just think it's swung back round. Now, of course, FTSE hasn't had a great 2022 in absolute terms, but in relative terms, it's been the best place to be. So it's good to see that rotation coming through, and not before time, I've got to say.
I suppose the question now is, can it continue? And if it can, where should investors be focusing upon?
Well, I think that what we've been used is a long spell, as I said, of growth doing well. You know, you go back to sort of 15 years or so, and the value had a terrific 5 years at the start of the 2000s. And if you take the very long term, you go back to the 70s, value outperforms growth quite comfortably. But if you actually look at it from the 90s and then the MSCI World Index, growth outperforms. You do get long periods where things swing. And I think that there's a little bit of a view that this is just a blip and the growth story will get going again. in the spring, but I don't think that's the case. I think you've still got extraordinarily good value to be picked up in value stocks, and particularly in the UK. So we actually think this is the seminal moment. This is the swing where you're going to go back to what Benjamin Graham would say, from 1934 is the more normal way of long-term investing, which is to buy stocks at reasonable values with a margin of security. You're not getting that in the big five, are you? No. So you get still set stacks of that in the UK. So although it's had this relative outperformance for us, you're still buying on near record spreads relative to growth, and we think there's a lot more to come.
Okay, it sounds really positive for investors, and certainly the research that I've been doing and how I've been positioning our own portfolios has certainly benefited from that. Now, you run the Courtiers UK Equity Income Fund. The search for income has never been greater. That's even before you consider, obviously, the inflationary background that investors are having to deal with at this moment in time. What can your fund offer to income investors?
Well, firstly, if you look at what the alternatives are available to them in long dated bonds, where you're going to take on a lot of interest rate risk, and if you've got to go quite a long way out to get 2% or so as a yield on UK gilts. If you're at the short end, despite a recent increase in interest rates, you're not getting very much. No. And what Andrew, for being in this business for so long, is that what your investors want is an increase in purchasing power. Yes. So if you pile into things that have got supposedly safe with just low yields, premium bonds, deposit accounts, treasuries, you're getting nowhere near the rate of inflation. In fact, interest rates may have gone up recently, but when you think of it, with inflation going up to 7.5%, the real interest rate, the difference in what you're getting on your money and the rate of inflation, is as big as it's ever been.
Absolutely.
So you come to our fund and you get 30 odd stocks, which are yield orientated, yield 4.25%, which is an awful lot better that you'll get in long dated gilts or cash or corporates or anything else for that matter. You can go and pick up a bit more if you're prepared to go to the high yield end of the market, but that's been pretty inflated as well. And if interest rates do rise, then fixed interest bonds are going to get hammered. So I think equity income is a great place to be for the investor that wants natural income.
Yeah, and just kind of finishing on that point, there's a lot of UK equity income funds out there. Less than what they were, though, let's be honest, simply because of the fact that growth has just been massively in favour for so long. You guys do differentiate yourself with regards to your process and your approach from other equity income funds. Do you just want to touch on that for a couple of minutes?
Yes. So there are a couple of things that make ours, I think, quite unique. Is that it's an equally weighted portfolio. Now, that means that we allow 30 to 33 stocks in the portfolio. When the beauty of that is not only do you not get one stock that forms too big a part of the portfolio, so that takes some of that type of granular risk out. But the other beauty of it is from the analyst has only got two choices, yes or no.
Yeah.
And you can't sit on the fence. And we like that. And our specific process, the stock gets selected on a model. We call it the quantitative equity selection model, QESM. The selected stocks go to the analyst. We have specialist analysts in all the main GIC sectors. And then the analyst has got two choices. One, to reject the stock and give a reason for it. So their job is to look. The model said, we want this. Yeah. The analyst has to say, no, because, and those becauses tend to be around earnings are overstated in some way, or it's in a bad sector and we don't like it, or management has got some problems. So they're the reasons that it might get rejected, or the analyst says no reason to reject. And that puts the analyst on the spot because they can only go two ways. This business is of equal weight, overweight, underweight, reject, No, you've got two choices.
Yeah.
And that means that we then have to look at it and say, okay, we got a stock filling a slot. So if another, it might be doing okay, but if another stock comes along that's got a high value rating, delivers better income, better quality characteristics, higher value score, which means it's probably got, lower PE, higher cash flow yield, then you can knock one out and put the other one in. So it's forcing decisions.
Yeah.
And I like binary decisions because I think it's much more effective. The analyst is they can't get off the hook. Is it in or is it out?
Yeah, it drives conviction. It makes a decision that has to be made, and that for me is something that's really interesting, and possibly one of the reasons for your excellent performance. But we'll leave the viewers to go and research that on their own. Anyway, Gary, it's been an absolute pleasure to talk to you and catch up with you once again. It's great to speak to you always. You stay safe, you take care, and I'm sure we'll catch up soon.
Thank you, Andrew. Really enjoyed it. Thanks for the chat.